We are live again. I just did a video on the energy sector, uranium, oil, or OIH, XOP, etc. Looks really good here. It was a big day for the energy sector, so hopefully that can carry on into the next week. I would highly suggest you to look into that video. It was quite constructive, to say, in a not so bullish way, but I really liked it. In this video, we are going to look into the Twitter technicals. What have I been saving for this week or the past few days? So let's see what the people have to say. Just quickly a run through here. So it's not only my charts that I'm posting, but it is what I find interesting during my day when I scroll through my Twitter feed. So yeah, let's have a look. See. Okay. This is J.R. Wolanski. Go away. The Denison mine is wasting no time rebounding above its 200 moving average after finding support at the 30-day moving average. Looks bullish. Let's check out the chart here. As you can see, yesterday was a very bad day for uranium, down 4% overall. Some of the miners were down even more. So you can see here the big drop into the 50, which is coming up from below. And we are rebounding here today, taking out the body of the last week's candle. Very good, very quick retrace or recovery from the damage that we saw yesterday. And if you were to make a trend line, you have it here all the way down, as you can see, boom, boom. So this is where we need to clear above here for the next week. Looks really good. And this is the same. Okay. But yeah, great recovery actually for Denison Mines here. That's well noted here. Hedgehog Trader. Let's see. Gold miners, the GDXJ versus US markets, the SPY. You can see here the MACD is having a bullish crossover on the daily, and we are having a higher low here. So this could be, I think it could be the bottom here for this move down. Also, when you factor in, you have the 1, 2, 3, 4, 5. So we have the big wave down, the 1 to 5 Elliott wave down, and if we can get above this candle here, in my view, the 0.0827, that's a lot of numbers, but anyways, then in my view, we will confirm the count for the Elliott wave. And if we do, that's also where this MACD will become even more bullish to the upside. Looks quite good here, but still a lot of work to do. We need to get above all the MAs and so on. So still looks good. Looks good. This is Sahara, great channel or account, by the way. You should definitely follow this guy or girl. I don't know, but still insanely good content here. And this was yesterday. No, it's today actually. And this is gold. Boom. And we need to clear. Actually, I haven't noted this one, but the 1940 level is quite big on gold, I can see. So a lot of resistance coming here within the next $10, $20. But if you can get above, confirming the breakout of this squeeze here, which we have been looking at on the channel for gold, then we have the breakout and we are above all bigger resistances. Let's go. Looks good. Looks very good. Grady, good old Grady. This is not the most joyful post, but it's vital to be aware of what's going on. I think this is likely to play out, unfortunately. Fed will probably try to save the bond market before the USD, but the global ledger or leverage debt mountain will be taken down or taking treasuries down. And basically what he's saying here on the chart is we're getting a bounce here, probably all the way up to this dotted blue neckline or the blue line here in this range. And that's when, rates will go down and everyone will say, yay, inflation is over. But that's when the real pain, as I have been posted on Twitter, also on the chart on YouTube here, when we get this second wave of inflation, that's where it's gonna sting insanely bad. People have no idea what's coming, and it's gonna be really sad. And the politicians knows what's coming, but they will not say it, of course, because they don't want to create any panic. But this right here, in my view, we will get a move down here for the next 2 years. I completely agree. We need to retest the blue neckline or the blue trend line here, and then boom, we will go higher. We will go way higher. And the bond market will tank big time. And then the Fed will step in to save the bond market, but that will be at the sacrifice of what? The dollar. So it's not good. It's not. It's really If you think about it, if you are a normal person, this is insanely bad here. Okay, again, Sahara here. The dollar index or the USD, the DXY, another bear plot. What he's looking at, the pennant here added to the mix. I also have this marked on my chart, and we are breaking down today, I think, or was it yesterday? Today we are breaking down here. So we are, in my view, going all the way down to this overall long-term, let's call it neckline, whatever, but still long-term support. And we will get a small bounce here, and then we will roll over. And the dollar will be in for quite some pain. And when this breaks, as you know, I've been looking at the level 100.8, which is also in this range. Excuse me. That's when gold will go through all-time highs at 2070, 75 in that range. I completely agree what he says here. Grady again. XME looks ready to yet again outperform the SPX up from the commodities bear market lows. These two here are the bear market lows, 2016 and 20, the big crash in 2020. And above the black line, we will see metals mining sector start to move very strongly again. I think the second inflationary wave is soon upon us, as we just talked about. Within the next year or two, shit will hit the fan, and people will yet again feel the pain from higher prices, just when everyone is celebrating. But again, I agree here. A breakout, retest, retest, and we are just trying to curl back up again here and getting above the 0.15 level. In my view, we have a perfect double bottom with a handle or a flag, whatever you want to call it, but still very bullish formation. And then boom, the XME will outperform this buy. And that's why we are positioned in gold and silver, even though it hasn't been fun for the past 2 years. Sahara again. No, we will not talk about this one. This is an older version of what we just looked at here. Patrick Rahim, also one of my first followed account I did on Twitter. He's really good, does some very weird charting, different takes, different ratios, but it's quite informative the way he puts it. So he's a really cool guy. I like him a lot. He says, "Who remembers the 1970s?" I don't. I wasn't born, but the chart I have imprinted in my head here. You can clearly see here the 7-year rate of change for the U.S. wages is going up, together with a rising 10-year yield, together with rates, of course. And now we are trying to do the exact same thing again here. So again, as we just looked at, everything is pointing to higher rates, higher inflation for the next 10 years. And it's gonna stink big time. But I completely agree. It's a different view on what we have just looked at, but still pointing to the same thing. This is not a chart. Actually, I said I only want to do charting, but I found this quite interesting, this one here. 10 timeless investing principles visualized. If you want to build wealth, you have to invest. And I agree, because this, if you save money, you do it very slowly. And many people can't even outcompete inflation. So yes, they might see more money on their bank account, but the purchasing power is the exact same. So you have to invest in order to get a wealth creation effect for you and your family. And yes, the pullbacks here is what people are afraid of. But actually, when you think about it, the pullbacks you actually have to endure, or you have to embrace, excuse me, because that's where you want to accumulate. And the pullbacks is healthy most of the time. Yes, you'll get crashes, but that's why you always have some cash on the sidelines to get that kind of a hedge against if you have a big crash and your investment goes down 30 to 40%, at least you know you can buy low and ride the move up again overall. So yeah, I completely agree here. Again, it's not a technical chart, just to show you. This is the average gold price through the year. We are in July. This would be very nice if this is what we have in front of us. And this means that we will break out of the all-time high for gold later this year. Amazing. The last chart is Grady. What does he have to say for us today? Take a long, hard look at this chart. Why? Because it's your ticket out of the rat race. As a proxy ratio chart for the two sectors, silver produces, AG is extremely undervalued versus the tech darling NVIDIA. Fortunes will be made. Historical opportunity. Do not miss. Again, I completely agree that where you want to be invested is into commodities overall. Yes, gold and silver miners has been taking a beating heavily for the past 2.5 years, but this is exactly why you want to, in my view, again, not financial advice, is to invest into the miners because gold and silver will go higher in the short term here. And as mentioned, gold will probably break out during Q3, Q4 this year. And that's where the miners will really take off. So you have a wedge, falling wedge here, which is bullish. False breakdown, I agree. It's a false breakdown. It will pop right back up to the upside. And the target for these wedges here is often, not right away, of course, but still, it's always the top of the triangle. Well, not always, but often the top of the triangle. And if you have symmetry, which you often have, you can see this is 2000 and let's call it 13, and we are now in 2023. So this is a 10-year period, right? Meaning if you add to the other side, you should see this level get hit somewhere 10 years out from now. So in 2033. And it's a big, you can see the difference here. It's it's roughly, what is it? Jesus Christ. It's 54,000%. Really? Yeah, it is. So if this plays out again, you will be set for life in my view. Anyways, I hope you like the charting here. Comment below if you agree. Again, this is not my charts, but I find them very interesting for you, so I will show it. Again, have an awesome weekend, and as always, stay safe. And yeah, bye guys.